House rejected the $700 billion bailout plan, sending shockwaves through Wall Street. The bailout plan was voted down 228 to 205.
Brothers is going bankrupt, and financial markets from Asia to Europe are doing their utmost to prevent Monday from turning from dark.
The 600 trillion derivatives time bomb. Why the next crash could be worse than 2008. What if I told you that right now, hidden deep inside the world's financial system, there's a $600 trillion time bomb quietly ticking away? A bomb so massive, so complex, and so interconnected that if just one piece fails, the entire global economy could freeze in seconds. This is the world of derivatives. And the truth is, the next crisis might not look like 2008. It could be far, far worse. Today, we're diving into the mysterious, barely understood universe of derivatives. The contracts that touch everything from oil prices to interest rates, currency stability, mortgages, bonds, and even your bank account without you ever realizing it. This is a story of power, risk, and the largest financial gamble in human history. Let's begin. What exactly are derivatives? Simple plus engaging. Imagine betting on whether the price of gold will move up or down. Now imagine banks, hedge funds, and governments placing millions of those bets every second. That's a derivative. They are financial contracts that derive their value from something else. Gold, oil, currencies, interest rates, stocks, mortgages, even future weather conditions. Here's the crazy part. Derivatives don't require you to own anything real. You're just betting on movement. This means the financial system is built on layers of contracts stacked on top of thin air. And the total value? Over $600 trillion. Some estimates go over $1 quadrillion. Let that number sink in. It's more than 6 times the size of the entire global economy. Why derivatives matter, and why they're terrifying. Derivatives are everywhere. They are used to manage risk, but they also create enormous risk. Banks use them. Corporations use them. Governments use them. Even your local bank may hold them without you knowing. The problem? All these contracts are connected. That means when one bank fails, all its counterparties, the institutions on the other side of those bets, get hit. This chain can spread faster than wildfire. This is exactly what happened in 2008. Remember Lehman Brothers? That was a tiny derivative failure. Most people remember the real estate bubble. But behind that bubble was something far more dangerous: derivatives tied to mortgages. When homeowners began to default, the mortgage-backed derivatives collapsed. Lehman Brothers was holding too many of them, and when Lehman fell, it nearly took the global financial system with it. But here's the terrifying part. The derivative market is now even bigger than it was before the 2008 crash, and far more complex, and far more interconnected. We didn't remove the bomb, we just covered it with a fresh coat of paint. The 3 biggest reasons the next crash could be worse. 1. The market is too big to control. Central banks printed trillions after 2008 and again during COVID. They saved the system, temporarily, but a $600 trillion web of derivative bets is beyond rescue. It moves too fast, it's too global, and it's too complex for even the world's most powerful institutions to fully understand. 2. Hidden leverage. Banks don't have to report the real size of their derivative exposure. This means many institutions may be sitting on mountains of hidden debt without the public or regulators ever knowing. It's like looking at an iceberg and ignoring the massive part underwater. Third counterparty domino effect. This is the biggest danger of all. If one big player collapses, every institution connected to it through derivative contracts takes a hit. This creates a cascade of failure. One bank falls arrow, 2 more get dragged down arrow, 5 more freeze credit arrow, markets seize arrow, currencies swing arrow, entire nations panic. The system is too interconnected for anyone to safely exit. The trigger. What could set it off? A huge derivatives explosion doesn't need a dramatic event. Sometimes the smallest spark is enough. It could be a sudden spike in interest rates, a major bank quietly going insolvent, a government default, a currency collapsing, a hedge fund losing a massive bet, or even a geopolitical shock. The frightening truth? Derivatives amplify small problems into global disasters. A tiny fire becomes a world-ending explosion. So here's the question you should be asking. If the 2008 crisis nearly destroyed the global economy, and that was caused by a tiny corner of the derivative market, What happens when today's $600 trillion web of financial bets starts to unravel? This isn't a prediction of doom. A reminder that the global economy isn't built on stability, it's built on confidence. But confidence is fragile, and when it breaks, the world changes overnight. If you found this breakdown eye-opening, intriguing, or even a little unsettling, make sure to like, subscribe, and share this video. And remember, the biggest risks are always the ones we can't see.